Stellantis owns 14 car brands including Jeep, Ram, Peugeot, Fiat, Dodge, Chrysler, Citroën, Opel, and Maserati. On paper, that should give it almost every advantage an automaker could want. It can sell pickup trucks in America, compact cars in Europe, commercial vans, luxury vehicles, gasoline models, hybrids, and electric cars. But that enormous empire recently produced one of the largest strategic reversals in the auto industry. Earlier this year, Stellantis recorded a €22.2 billion write-down as it reduced electric vehicle investments, addressed quality problems, reorganized factories, and admitted that some of its previous sales assumptions had been too optimistic. The company had once planned for fully electric vehicles to represent all of its European passenger car sales and half of its American passenger car and light truck sales by 2030. Demand did not develop as quickly as expected. Now Stellantis is attempting a $70 billion comeback built around 60 new models, renewed investment in gasoline and hybrid vehicles, stronger brands, better factories, and a surprising partnership with a Chinese carmaker. The central question is not simply whether Stellantis can sell more cars. It is whether a company with 14 brands can stop behaving like 14 separate problems and start using its size as a genuine advantage. The latest results show both progress and danger. Stellantis reported second-quarter revenue of €43.5 billion, up 13% from a year earlier. North American revenue rose 32%, and the company returned to a small net profit of approximately €300 million. Adjusted operating income more than tripled to €773 million. That sounds like a turnaround. Investors disagreed. The operating result remained below expectations. The group's adjusted operating margin was only 1.8%, and the shares fell after the announcement. Europe remained especially weak, while North America was improving from such a difficult position that even strong growth did not restore the profitability Stellantis once enjoyed. The contradiction explains the entire story. Stellantis is recovering, but it is recovering from damage that was largely self-inflicted. The company was created in 2021 through the merger of Fiat Chrysler and France's PSA Group. The logic appeared powerful. Combining their brands, factories, engineering teams, purchasing operations, and vehicle platforms could reduce duplication and create enormous economies of scale. Imagine two restaurant chains merging. Both buy meat, vegetables, packaging, software, and kitchen equipment. By placing larger orders together, they can negotiate lower prices. They can also share delivery networks and develop common kitchen systems instead of maintaining two separate operations. Automakers use the same principle, but at a much larger scale. A modern vehicle costs billions of dollars to develop. If Peugeot, Opel, Fiat, and Jeep can share an underlying platform, battery system, electronics architecture, or engine, Stellantis can spread that investment across millions of vehicles. The customer sees different styling and branding. Underneath, much of the expensive engineering can be shared. But there is a limit. Too much cost-cutting can weaken the very brands the merger was supposed to protect. Under former management, Stellantis became known for strict cost control and high pricing. That initially produced strong margins, but dealers in North America complained that vehicles had become too expensive and inventories were accumulating. Product launches slowed, quality concerns damaged customer confidence, and market share declined. A company can improve profit per vehicle by raising prices. But when customers stop buying, the calculation reverses. Suppose an automaker earns $5,000 on each of 1 million vehicles. That produces $5 billion. If it increases the profit per vehicle to $7,000 but sales fall to $600,000, total profit falls to $4.2 billion. Higher margins become meaningless when volume collapses far enough. This is the first problem the new strategy must solve. Chief Executive Antonio Filosa is trying to restore coverage in the parts of the market Stellantis abandoned or neglected. The company plans 60 new models by 2030, including gasoline, hybrid, and fully electric vehicles. Instead of forcing every customer toward the same technology, Stellantis wants to offer several powertrains and allow demand to determine the mix. That is more than a product decision. It is a reversal of how the company predicts the future. The earlier strategy assumed regulation, government incentives, charging infrastructure, and consumer demand would push electric adoption quickly enough to justify enormous investment. But electric vehicles represented only 19.5% of European new car sales and 7.7% of American new car sales in the period cited when Stellantis announced its write-down. The company had prepared for a market that was arriving more slowly than expected. Its new approach treats flexibility as insurance. A shared vehicle platform may support gasoline, hybrid, plug-in hybrid, or electric variants. If electric demand accelerates, Stellantis can increase electric production. If customers continue choosing hybrids or combustion engines, it can supply those instead. This lowers the risk of betting the entire company on one forecast. But flexibility also costs money. Supporting several technologies requires more engineering, more suppliers, more factory complexity, and more inventory. Stellantis must avoid replacing one extreme strategy with an expensive collection of compromises. That is why the company is concentrating resources on 4 major brands: Jeep, Ram, Peugeot, and Fiat. These brands give it strong positions in important categories and regions. Jeep and Ram are central to North American profits. Peugeot is one of its strongest European names. Fiat gives the group access to affordable small cars and large markets outside the United States. The strategy resembles renovating a large shopping mall. The owner may have 14 stores, but not every store attracts the same traffic. Investing first in the strongest anchors can bring customers back and support the entire property. Ram and Jeep are already helping. Higher sales from these brands contributed to the 32% increase in North American revenue. Yet the regional operating margin was still only around 1.6%, far below the 8.6% recently reported by General Motors. Selling more vehicles is only the first step. Stellantis must sell them without relying on destructive discounts, excessive incentives, or costly production inefficiencies. Europe creates a different challenge. Stellantis has many European factories and brands, but the regional operation recorded a negative margin of approximately 0.6% in the quarter. Chinese competitors are introducing affordable electric and hybrid models, forcing established manufacturers to reduce prices while still carrying the costs of older factories, large workforces, dealer networks, and regulatory compliance. Stellantis cannot simply copy Chinese prices without changing its own cost structure. So it is using a Chinese company to compete against Chinese companies. Stellantis owns a major stake in Leapmotor and has created an international joint venture to sell Leapmotor vehicles outside China. This gives Stellantis access to lower-cost Chinese electric technology while Leapmotor gains access to Stellantis' distribution, regulatory knowledge, and manufacturing infrastructure. The arrangement is strategically unusual. European automakers traditionally protected their technology and brands from Chinese challengers. Stellantis is acknowledging that partnership may be faster than attempting to reproduce every cost advantage internally. Think of Leapmotor as a laboratory and a shortcut. Stellantis can learn how a Chinese manufacturer develops vehicles quickly and cheaply, while using its own dealerships and market presence to distribute them. But this creates another contradiction. Every Leapmotor sold in Europe could help Stellantis compete with BYD and other Chinese brands, yet it could also take a sale from Fiat, Peugeot, Citroën, or Opel. The partnership succeeds only if it captures customers Stellantis would otherwise lose, rather than moving existing buyers from one group brand to another cheaper one. This is the hidden difficulty of owning 14 brands. More brands create more market coverage, but they also create overlap. If 2 vehicles share similar prices, sizes, technologies, and customers, Stellantis may be paying to market 2 different names that compete against each other. The company must make each brand stand for something clear. Jeep needs to mean capability and adventure. Ram needs a strong truck identity. Peugeot must offer a recognizable European design and driving experience. Fiat needs to remain accessible and urban. Shared engineering can reduce costs, but the final products cannot feel interchangeable. The $70 billion plan also depends on better use of factories. An underused factory is enormously expensive because labor, maintenance, energy systems, and equipment continue costing money even when fewer vehicles leave the production line. Stellantis wants to improve capacity utilization and use partnerships to fill factories that might otherwise sit partially empty. However, the company faces tariffs and other external costs estimated at roughly €1 billion to €1.2 billion this year. Currency movements, regulatory changes, and intense pricing competition could consume much of the benefit created by internal improvements. That explains why management says the recovery will take time. Stellantis expects moderate revenue growth and aims to return to positive industrial free cash flow next year. But a genuine turnaround will require more than improved quarterly comparisons. It must rebuild pricing power, quality, dealer relationships, market share, and customer trust at the same time. The lesson extends beyond the automobile industry. Large mergers often promise efficiency through scale. Yet scale creates value only when management knows what should be shared and what must remain distinctive. Stellantis should share platforms, purchasing, software, and manufacturing technology. It should not allow Jeep, Fiat, Peugeot, and Maserati to lose their individual identities. Its previous strategy focused heavily on controlling costs and preparing for one predicted electric future. The new strategy is broader, more flexible, and more expensive. It accepts that customers in different countries will move toward electrification at different speeds. That may be less elegant than one universal plan, but it is closer to how the global car market actually works. Stellantis has already paid €22.2 billion to acknowledge that its earlier assumptions were wrong. Now it is spending $70 billion to prove that its collection of brands, factories, partnerships, and technologies can still become an advantage. The company does not need all 60 new models to become enormous successes, but it does need enough of them to answer a question that has followed Stellantis since the merger. Is it truly one powerful global automaker, or merely 14 famous car brands sharing the same financial problems?